Hey everyone, welcome back to part 2 of the most important rule for making millions video. In this video, we're going to be covering the behavioral finance aspect of investing and how our human nature can negatively impact our investing decisions. This is likely a time where many could be seeing massive losses in their investment accounts and human nature is screaming at us to sell. But this is totally wrong and can create massive permanent losses. The 8th tip is to not be afraid of being alone or contrarian in your opinion of a company. That being said, please do make sure that you run your analysis by someone you trust and truly listen to their individual critiques of your thinking. I personally speak to my friend Thomas, my cousin, shout out to Positive Investing, or my dad about my investment ideas to make sure I can simply explain my thesis. For example, I liked Visa stock and thought they're a great long-term growth story, so I was considering increasing my position size. However, my dad mentioned to me that in India, there's a company called RuPay that can capitalize on its local operations to undercut Visa and MasterCard. Recent projections show that it may actually overtake Visa and MasterCard in popularity in all Indian retail transactions soon. Given that India is a massive part of the global population, this can be incredibly damaging to Visa and MasterCard's long-term growth story. This was new information to me, and since I haven't been able to do a lot of additional research in MasterCard and Visa, I haven't actually added any more to my Visa position and need to consider the possibility of RuPay's business model being widely adopted in other countries. This may actually trigger me to sell the remaining shares that I own, and you shouldn't be afraid to change part of your analysis if you agree with the other person's thoughts. The 9th tip is to be confident in your decisions and judgment once you have done your due diligence and gotten feedback. Remember, there is always a seller when you're a buyer and vice versa. And even if someone like Jim Cramer has an opposing opinion to yours, that doesn't mean they're more correct than you just because they're on TV. Every stock is different, and every stock needs hours of analysis poured into it. If you spent the hours to do the analysis, you're probably better off than others, even expert investors, if they haven't really taken the time to understand the value drivers of the company and its financial statements and position. The 10th tip is to find an analytical process by which you analyze companies and become an expert at using it. It is helpful to have this because it helps create discipline and focus, two things incredibly important in investing. Understanding the value of a growth stock versus a value stock, for example, is very different, and spreading yourself too thin is an easy way to make mistakes and, you guessed it, lose money. The 11th tip is to listen to the advice of people you respect and examine what they do themselves to generate returns. Guess what? You're already doing this one. You're learning from Buffett, Schloss, Lynch, Munger, and all the greats of our time by being subscribed to this channel and listening to this video and others. So good on you. You've got this one. The 12th tip is to avoid using leverage or taking on debt personally to invest. Volatility is not a perfect definition of risk. Rather, risk is better defined as being the permanent loss of capital or the potential to have the permanent loss of capital. If you invest using leverage, which can be done through using a margin account or by borrowing elsewhere and investing, then you are exposing yourself to the possibility of a margin call or a monthly debt payment that could force you to have to sell stocks at a loss or at a time where you wish you didn't have to sell. You can pause the slide on the screen right now if you'd like to read an example of what could possibly go wrong when investing on margin. The 13th tip is that you should not buy a stock on a tip or through an impulse buy. Always do some additional research before opening a position if someone gives you a tip. Would you buy equity in a random business owner's enterprise without looking into it? No, of course you wouldn't. If your analysis points to a yes to the second and third points on your screen right now, this is a huge red flag and you need to be very careful moving forward. I have an extremely recent story that portrays the potential dangers of not following this advice. One of my friends from university, Thomas, mentioned a stock to me that he thought could rival Starbucks and was experiencing amazing sales levels and growth and could potentially be a better investment. Some of you may already know where I'm going with this, but the company my friend was mentioning to me was Luckin Coffee. Now, his recommendation was not just out of the blue. He had considered their sales figures, store count, and other factors relative to Starbucks and thought this was a sound investment, which is fair. Thomas had done his preliminary analysis, but I mentioned to him that we should look into their numbers further and see if they're relatively similar to Starbucks. Companies shouldn't face extremely different figures or proportions just because they're from different countries. Unless, of course, there's something phenomenally different or better about their business models, which we would also have to look into. In this case, Luckin Coffee's COO was manipulating sales records in vast quantities. If we went and bought the stock on my buddy's recommendation from his preliminary analysis alone, we would be down 84.07% on our position right now. Further, this goes back to tip number 8, where I spoke about talking to someone you can trust for additional insight that you may have missed. In this case, Thomas had not had any reserves about investing in international firms and would have likely put in some money into the stock if he did not follow tip number 8 already. The 14th tip is to have patience and a long-term perspective when investing. We can do this by creating a mission statement. This mission statement should highlight a few things. First, the goal of the portfolio. Second, the time you have to reach your goal. Third, the capital you'll have to put into the portfolio now and in the future, ideally on a recurring basis. Fourth, the investment strategy you plan on using to achieve your goal. And finally, fifth, what ending balance the investor will need to have to be able to retire. Based on these factors, you can determine the returns you need to generate on a yearly basis to reach your goal. If you do this, you'll quickly realize that your goals are achievable with modest returns so long as you don't lose money. We'll use a simple example here to illustrate this. The goal of our example investor will be for them to live off their portfolio returns. We'll assume the investor is a 21-year-old aiming to retire at 65, which gives them 41 years to do so. Third, the investor will start with just $10,000 in their account and contribute an additional $6,000 yearly. Fourth, the investor will simply buy the market. Fifth, the investor will hope to live on $56,000, which is the median salary in Canada right now, in retirement, but we'll adjust this for inflation, which is equivalent to about $93,834 in 2049 money. We can then multiply this figure by 25 or divide it by 4% to get the total portfolio size required to retire. Upon doing this, it might seem like a crazy goal to think that you can go from $10,000 to over $2 million, but we'll quickly see that this is extremely manageable and risky positions are unnecessary. Now that we have the mission statement, we can use an investment calculator to determine what return the investor will need to achieve these results. As you can see, the investor needs a simple 7.877% return. This should prove to most people that you don't need to chase risky stocks to retire with a good living. This is also similar to the return the S&P 500 has achieved since 1957, so it's not unreasonable for the investor to expect to achieve this going forward. Since I appreciate all of you who stick around to the end, I have a few bonus tips. Tip number 15 is to avoid investing in companies with valuations that are driven by commodity prices. This is why I have no direct exposure to oil companies in my portfolio. There is tremendous risk that comes with these companies unless you really understand the underlying commodities and their uses in the coming future, which is not a bet I like taking or am willing to take right now. The two prevalent examples I'll give now and cover in detail in future videos are Aurora, derived on cannabis prices, and Suncor, whose valuation is derived on oil prices. In Aurora's case, selling price compression on dried flower has resulted in significant write-offs for the company. In Suncor's case, oil prices have taken a nosedive, and there are significant pressures that could keep oil prices low into the long term, such as increasing popularity of electric vehicles. The 16th tip is catching up on lost money is like chasing a cheetah. It's simply mathematical. I'll leave a chart here to do the explaining for me. If a stock you own loses 10%, it's not so bad. But as you can see, things quickly take a turn for the worst the longer this trend continues. When your stock price is down 90%, you actually need a 900% gain to just bring the stock back to break-even levels. This is why we must focus on avoiding losing money. So these were 14 of the most important value investing tips from the legends that have helped me avoid losses for years. I hope you learned something today and are going to be more selective with your investments in the future. Just remember, there are thousands of stocks out there. There is no reason to take risk on something that you think is a shot in the dark. Don't forget to share the video with your friends and families, leave a like, and comment your thoughts down below, as these things really help the channel out. If you enjoyed the video and want to see more, please do subscribe to the channel and let me know what topics you want to see covered in the weeks and months ahead. Have a great day, everyone, and remember to always be eager to learn, willing to invest, and prepare yourself for success.